investors watching your money. Joining me right now is Anderson Capital Management Chief Investment Officer Peter Anderson, Brig McAdam founding partner Greg Swenson, and the Fitz-Gerald Group Principal Keith Fitz-Gerald. Great to see everybody this morning. Thank you so much for being here, gentlemen. Keith, kicking things off with you. We've got a market that is inching higher, but once again in record territory. The Nasdaq and the S&P 500 closing at all-time highs yesterday. The Nasdaq above 15,000 for the first time ever. We are waiting on Federal Reserve Chair Jay Powell's speech at the Jackson Hole Symposium on Friday. But I got to tell you, Keith, as I continue to hear Fed governors and presidents talk about where we are with the macro story, it feels like there is a suggestion that maybe they will move to push out the tapering. Maybe, like, for example, Robert Kaplan, the president of the Dallas Federal Reserve, my guest last week, he was initially saying, yes, let's start to pull back the bond purchases by October. He said he wants to watch the impact of the Delta variant. He may be changing that opinion. Your thoughts on when the Fed starts to taper, what you're watching here in a record setter once again?
Well, I tell you, psychology is everything. I think the observation you've made is the same one that traders and big investors have picked up on. The situation reminds me of a kindergarten class where you got the one troublemaker, who presumably was Kaplan, to get to severe talking to by the teacher. Hey, calm that down. Let's bring the class in line. So I think what's happening is traders are trying to get ahead of it. They can't afford to be on the sidelines, so they've got to be on the gas as we shift towards recovery, as we get better data. And if Chairman Powell is able to thread the needle without upsetting the markets, I think we power potentially another 4 or 5% higher from here.
Wow. All right. Well, Peter, UBS Global Wealth Management says that they see the S&P 500 rising to 5,000 by the end of next year. That would be a jump of 12% from current levels. UBS also telling their clients an accommodative Fed, economic and corporate profit growth are the reasons behind this position, that this thing keeps on going. Are you a buyer?
Well, Maria, I think the important part is reading the footnotes in that message and, all the assumptions they're making. If everything goes flawlessly, sure, I think that we could be up 12% from here. I mean, just doing the math, that's only another 4% through this year and then 8% next year. So the S&P 500, I think, could go up that high. Of course, I don't buy the S&P 500. I buy individual stocks. So absolutely, the 14 stocks that I own them because I think they will go up at least that amount by the end of 2022. So I think it can work, except we've got a three-ring circus going on now with a lot of other factors that I think we have to carefully watch. If they play out in our favor, especially Afghanistan and the Fed's tightening and all that issue about if they're going to be raising rates, if that all works in our favor, I do think that that is very, very possible, yes.
Yeah, I'm glad you brought this up because I wonder how much Kabul matters to markets, Peter. I've been quoting these last week or so Bernard Lewis, who said, a famous historian who said that global destabilization happens when America is not trusted by friends and is seen treacherous and not feared by enemies. Your thoughts on whether or not Kabul and the Afghanistan pullout will matter to markets?
I couldn't agree more, Maria, with what you just quoted. I think this is extremely important. I think now America appears like it's being led like a dog on a leash, and the aspect that we are negotiating with terrorists for August 31st is really, it will impact the markets. I'm not sure exactly how, but the long-term impact of that, I think you cannot discount at this point.
Yeah, I think you're right. I mean, this is, it's affecting markets now. Let's talk about oil, Greg. Oil trading slightly lower this morning following 2 days of gains. Prices up better than 8% in the last two sessions. Greg, your thoughts on the impact to oil and what is behind this move now at $67.75 a barrel?
Yeah, look, I think there's more room to the upside for oil. And I think, one of the challenges was some demand metrics coming out of China. But remember, there's some real supply glitches here. When you had the president of the United States begging OPEC to pump more oil a few weeks ago, that's a really troubling sign, although it's a very good sign if you're buying oil or if you're trading oil. So look, I think the fact that U.S. basically had energy independence before this administration and became the largest producer in the world was good if you were trying to keep prices down or at least at some respectable level. Now with cutting back on Keystone, cutting back and over-regulating the industry in the U.S., I think that's a real negative sign economically, but it's a good sign for oil prices if you're long oil.
So you're looking at the supply-demand situation. President Biden kills the XL pipeline, kills the ability to produce our own oil as we were independent before this administration, and that's impacting supply in the global market. What about the overall demand story? Do you see the demand picking up as things normalize, or is it questionable now with the questions around COVID and the Delta variant?
No, I think in 2021 and 22, I expect demand to be, hanging right in there. Look, the V-shaped recovery continues. I think the recovery story is still a good one. I'm more concerned with the long run. Inflationary pressures. Speaking of oil prices, that's really going to be, much of the movement in oil prices is because of the printing of dollars and the debasing of the currency. So, there's some issues beyond economic recovery, and I do think the economic recovery will continue to be robust in 21 and 22. But it's the long-term issues. It's overstimulating. It's keeping these emergency measures in place when the emergency is over, and yet restricting supply with the tax and regulatory burden, basically the hostility to job creators. And that's going to create some really, really worrisome long-term issues when you start looking at late 22 and 2023.
Yeah, I'm with you all on all of these issues. This is so important in terms of policy and its impact on the macro story, impact on the markets. Really important conversation this morning, gentlemen. Thank you. Peter Anderson, Greg Swenson, and Keith Fitz-Gerald. Gentlemen, we'll see you soon. Thank you so much.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.